These are my top 3 indicators any new trader should be using. Number 1, the first indicator you should be aware of or should start to use are levels, right? Now, levels aren't technically an indicator. It's very simply understanding what price has done historically. It's giving you an indication of previous buying and selling activity from the past, so that moving forward, you can understand what price may do in the future. If I'm approaching a level, let's say I'm on euro, dollar, and I'm approaching 1.08, and I can understand for the last 20, 30, 40 years that buyers and sellers haven't fight at this price point, well, I need to be aware of that. The solution to that is by using the level. So moving forward, if you're in a trade, if you're approaching that position, let's say you're in a buy trade and price is approaching this 1.08 level, without that indication there, you might be in that trade long, you might get to that price point with a big turnaround. So in my view, as a new trader, you need to be using these levels so that you have to understand what price has done historically at that price point before, so that you can make the appropriate decision moving forward. Might be a case that you're in, as I said, you're in a trade, your fast approach is 1.08 level, and then you close your position beforehand. Or let's say that trend is continuing to go to the upside. Well, what you need to see first is price break out of that area, and then look to continue with scaling into your buy position. So that's the first tool I'd recommend any trader use, which is a horizontal level to understand what price has done historically, so that you can then understand what price may do moving forward. The second tool I'd always recommend, the second tool I'd recommend any new trader start to use are moving averages. Right now, moving averages is a multi-solution indicator. Right, if you're looking for a sentiment change, let's say markets have gone from a downward movement to an upward movement, and you're looking for some sort of confirmation of that, using a 5 and 10 moving average. If you see that crossover, you can then use that for a confirmation. Right, we have a few traders that use a very simple strategy for long-term positions, where they look at the moving average crossover. Once it turns, they enter, and to exit, they look for the crossover on the way to the downside. Right, so it's a very simple solution, but it helps us understand the sentiment of the market. Right, as well as that, it gives you a great understanding of what price might be doing the short term as well. For example, if you're looking for intraday cycles, right, if you start seeing the moving averages start to turn across, it might indicate price with phase 1 to phase 2, so that you don't get caught out. You don't get caught out trying to buy in the phase 2 if we're in an uptrend, right? So moving averages is very, very important. And the last tool I'd recommend any trader start to use is what's called a stochastic. Now, a stochastic is an oscillator, and what it does is it helps indicate oversold or overbought markets. The age-old saying in trading is buy low, sell high. The stochastic will allow you to identify oversold and overbought markets, right? Where we are at the moment, yen pairs are at historical highs. We're talking decade highs now. Buying at the highest point on dollar yen might not be the smartest thing to do. Now, you can use a stochastic to reinforce that and understand that, right, because we're so overbought, buying this high might not be the best thing for you to do. What you want to see moving forward is you want to start to see that dollar yen price start to turn over. The point is the stochastic will allow you to understand where you are, so you don't buy high and sell low. So that would be my three. That would be my 3 sort of tools I'd recommend any trader start to use, just so you start to understand what markets will do moving forward. Any questions? Get in touch, and we'll catch up soon. 3 simple steps to help you build a very comprehensive trading plan. Number 1 is to know exactly what it is you're looking for. Right. When it comes to your justification of building a bias, when it comes to your entry and your management style, you need to be crystal clear what it is you're looking for. The market, one of the reasons why markets are obviously great is that everyone views the chart very differently, right? If I'm a long-term trader, and let's say if someone that's a short-term trader, straight away, the way me and that trader are going to look at the charts are very different, right? I'm going to be looking at more of a longer-term view, daily time frames, whereas that trader in question will be uses a smaller time frame, right? So straight away, I understand what time frame is more relevant to my style. Should I be a long-term trader? That's going to be more daily time frames, and therefore a daily sort of strategy to follow suit. So definitely one thing you need to make sure when you are building the trading plan is you're crystal clear in terms of your own parameters, your own system that you want to be using when it comes to trading. That's my first step. Number two is to make sure it's an adapting document, right? It's not just a document you do once and you set and forget forever. It's something that you wanna add as you improve as a trader, right? You might find that when you first started getting into trading, you built your first trading plan. There's a tool such as the pivot points, which you might have learned and actually start using to help improve your bias, your entries, and actually your exits, right? So it helps in all three areas. And that's something that you want to start incorporating into your trading plan. You want to think of your trading plan as if someone that's very new to trading that didn't know anything about it, you're able to give that person the trading plan and they can understand what sort of trader you are. So what justifies the entries, what justifies your management, and most importantly, how and why you look at the chart the way you do. The last and final step is to be very crystal clear with your risk management. You need to make sure when it comes to risk, you're able to manage it correctly, right? If you're not able to manage your risk properly, then you're not going to be in this game for very long. So making sure you're able to understand how to manage your risk appropriately can be very important. When it comes to scaling in or exposure at any given point, one recommendation we say is never to be overexposed to a certain asset class over 2 or 3%, right? So if you're looking to trade the yen, you don't want to be risked with the yen at 3% of your portfolio at any given time, right? Because if everything happens to that yen, you might be 3% down for that trading session. So that's not to say you can't take 3 positions, but making sure, for example, you take 1 trade on the yen, your risk manage, maybe bring a stop to break even, so you've got no risk on the table. That automatically allocates another percentage point on yen or elsewhere, right? So being very crystal clear on the risk management. So to summarize the 3 points, number one, making sure you're crystal clear when it comes to what it is you're looking for, entries, bias, management. Second one is making sure you keep it dynamic, make sure it's an ever-evolving trading plan as you grow as a trader. And finally, and most importantly, your risk management. Because like I said, without the proper risk management, you're not going to be in this industry for very long. Perfect. Hope that helped, and we'll catch up soon.